So let me start really by asking you about. I'm looking at the history of the global financial system and trying to identify, since Bretton Woods, the handful of really big events that you would consider to be inflection points. That is, events that really either changed the system or catapulted it to another level. It doesn't have to be totally exhaustive, but if you took five or six, what events would come to your mind?
This is a sort of huge question. So, in order, a sort of chronological order,
Yes,
I
chronological.
suppose, and that's quite important because there are events in the financial system, and there are events, if you like, in the global monetary system that surrounds it. And the crises are about, and the developments are about the interaction between the two. So I would say the first really important development after the creation of the whole post-war system, so I won't go into that, the Bretton Woods system, I think was the emergence of the international euro-dollar market, which was actually in the early 60s. And that was the first step, really, that crucial step towards the emergence of what we now simply take for granted, namely global markets, globally integrated. At that stage, they were actually an offshore market in London, but ultimately, interestingly, they ended up absorbing the whole London market, if you like. So I think that was the first thing. It was the beginning of the return of global finance, and particularly global debt finance. And a lot followed from that. I think the second huge development, obviously, was the collapse of the Bretton Woods system, which occurred in 71 after a lot of pressure on the dollar over a series of crises and conflicts, largely between the US and its European and Japanese ally. Finally, that system collapsed. We moved to floating exchange rates. And for the major currencies, that move was really immensely important. I would say that the third development, and this sort of comes together in a rather complicated way, was the shift in the United States towards a decisive shift away from high inflation to low inflation, the Volcker Fed, the creation of a stable dollar anchor for the new floating rate world. And that happened to coincide with a fourth thing, and actually they were closely linked, which was the first of the great emerging market financial crises, the Latin American debt crisis of 1982, if I remember correctly. So there we've got four very big events. We've begun to realize we're moving towards global finance. The recycling of oil surpluses in the 70s led to this huge amount of debt in emerging countries. And then the US suddenly changed the rules. So we're no longer in an inflationary world, we're in a non-inflationary world. That sort of broke the system. Then in the 80s, a series of events, what we call Big Bang in London in 1986, the increased move to the liberalization of the financial system in the US and elsewhere, started creating a really global financial system. And I think one of the big events in that, which I sort of add in that, was the European decision to go to a single currency, which meant getting rid of all the exchange controls in Europe. Countries like France and Italy still had exchange controls in 1990. We got rid of them in the UK in 1989, but these countries got rid of them only in the early 90s. And then suddenly these countries were all in the global financial systems, and it would have now become global. And then we started to see a lot of liberalization, more or less at the same time, in a lot of emerging countries, more or less bringing themselves into the system. Now, I would add two further major crises to this story, which has sort of shocked the system, but which actually, in a strange way, led to its deepening. The first was the Asian financial crisis of 97, 98, which changed their orientation to the monetary system very profoundly, and led in particular to their decision, which I think has been a crucial one, to accumulate reserves on an enormous scale, while and to manage their exchange rates in a way to prevent any further crisis of the kind they experienced in the 90s. The Latin Americans had had a similar shock in the mid-90s with the so-called tequila crisis in Mexico, and it also responded, though not as radically as the Asians did. And then finally, I think it's an inescapable event in this floating rate world. I should perhaps add on the Asian story that also led most of them to get away from fixed exchange rates as well. And the countries that stayed with fixed exchange rates also had exchange controls, like China. Not fixed, but heavily managed exchange regime. And finally, of course, the 2007 financial crisis, which was, I think, the first true, completely global almost completely global crisis of the new liberalized system. Now, I could add a lot of other events. I've ignored the Japanese crisis here, for example. There are many other events, but I would say those are probably the 6 or 7 biggest events in creating the financial system and the monetary system of today. Note that I have not included Glass-Steagall. I think it's the abolition of Glass-Steagall in the US in the 90s, though I think it's a significant, but I don't think it's a decisive event on this path.
Let me just follow that up and focus on one aspect of what you're saying. And now I'm going to focus on the financial system itself, less monetary. But if you were to, say, start with the 70s or 80s, when deregulation really started to get some traction, how do you think about the evolution of finance over these last couple of decades? What actually has changed of most significance?
Well, first of all, I think before I go into the policy and institutions, I think it's very, very important to remember sort of background technology facts, which I always stress here, right, which is we're living in an era of information and communications technology revolutions, and that has permitted the development of, in a way, it's not totally new. We've had international financial markets before, and we've had international crises before, but the development of these absolutely colossal, highly liquid, 24-hour-a-day trading machines of today would really have been impossible without the technological revolution. We're seeing the increasing role of, obviously, of computers as traders, the creation of all these sophisticated derivative products. None of that would have been possible without the technological revolution. And I think often when we discuss what's happened to the financial system, we, particularly economists, tend to underplay simply the role of technology. And along with that, by the way, there's also some pretty important, actually, intellectual ideas. I mentioned derivatives. I mean, the revolution in options pricing and all the rest of it, which goes back to the 70s. Again, without that, the modern financial systems as we know them, the risk management systems, would not have emerged. Now, with that as a background, as the financial system liberalized, as I said, within a floating rate world, certain key things emerged. First of all, they became truly global, and more countries were described as got involved, and the big players became global. That is to say, the major financial institutions of the world, there's a relatively small handful of them, are truly global players. They are rooted in individual countries, but they have vast global operations, which means that they are really hard to manage and regulate. I mean, really hard. I think that's incredibly important to understand. Along with that, again, linked with the changes, I think the system has become, on the whole, immensely much more transactional, market-oriented, as opposed to be relations-driven. The traditional investment bank, the traditional commercial bank, was a relationship structure. It had long-term relations with clients who it knew well, understood well, often with loans which were not traded, which they held on their books, or even in corporate advisory work. These will be very long-standing relationships. But that basically shifted to a highly transactional system in which one became heavily dependent on the quality of information embedded in the product, one's ability to understand that, and of course, one became enormously dependent on these enormous liquid financial markets as opposed for funding and for laying off products, disposing of products, rather than the traditional sort of bank deposit asset structure, which was really very long term. It might have been notionally deposits could be removed, but particularly after deposit insurance was generated in the 30s, explicitly, implicitly after the war, they didn't disappear very quickly. So we moved from this very long-term structure to this highly transactions-oriented structure. And that was, in my view, in essence, I've short-circuited it because of the breakdown of information, the deterioration of the quality of the information, because of the changes in the motivation of those who were participating in it, because of the emergence then in a panic of extreme illiquidity, we got this absolutely colossal crisis. We'd seen this before, but I think together, I mean, this is a very, very cursory overview, but I think these are the essential changes which have given us a financial system which is really profoundly different from what it was 40 years ago or so.
So, given that description, what is your view about the ability of the regulatory system to stay at least close to this kind of evolution?
I tend to distinguish, and this is my own thinking on this, but it's by no means unique, between, if you like, regulation and supervision.
Okay.
This is a sort of standard thing. It's an important standard distinction. Supervision consists of really looking at what they're doing, to some degree second guessing what they're doing on a day-to-day basis. And regulation, in my view, is about the framework rules of the system. Now, I tend to think, and my friends in the regulatory community will dispute this, that supervision is pretty nearly hopeless. I mean, I've become increasingly persuaded by recent scandals with which everybody's familiar that the management of these huge behemoths can't really supervise what their own staff are doing. Now, in some cases, it may be that they were turning a blind eye, but in some cases, it seems to me pretty clear they didn't really know what was going on in these colossal systems. Now, given the motivation of the employees, their enormous rewards, obviously something I didn't stress, but part of it, and their sheer intelligence, the chances that supervisors will pick up what they're doing, as it were, in real time before the system blows up is, to my mind, really quite small. And if we rely on supervision, we are going to find ourselves very disappointed. So I've tended to think about this in terms of regulatory structures, namely creating a system of incentives, a system for generating information to markets, and in particularly systems that generate robustness, rules that generate robustness in the system, rules about liquidity, rules about capital, relatively easy things to measure, rules about where assets can be traded over the counter or on markets. Everything, in other words, designed to generate greater robustness and greater transparency, policed in a fairly effective way by the market itself. That seems to me the way we should be going. I've personally been involved in one aspect of that, trying to break up in the UK, going, as it were, in a Glass-Steagall direction, trying to separate commercial banking from investment banking to a greater degree. So I tend to think simple, I'm not saying this is easy. I know it's incredibly difficult, but simple, robust regulatory structural rules are far more likely to work than very complicated ones, or even worse, attempts to actually supervise what these stupendously big institutions with their incredibly vast balance sheets changing daily are actually doing. I think that's probably a hopeless task and almost certainly will get us into another, and I fear at the moment, even worse crisis.
So we've been talking about the changing character of markets and the changing structures of the institutions. You deal all the time with men and women who are leaders, both on the monetary side and the financial side. What is your sort of view of the changing capabilities of these leaders, and also the level of confidence that you think they genuinely have that they can oversee, they can manage a financial system that doesn't run off the rails with too much frequency? I mean, I realize we'll always have financial crises, but how do you characterize these men and women today in terms of both their ability and their confidence?
I agree with you. First of all, it will run off the rails from time to time, but the sort of smash up we saw in 2007-8 is clearly not one we want to see repeated too often. I think if it is repeated, it is going to destroy the legitimacy of capitalism itself. And since I believe in this system, I don't want to see that happen. It is worth remembering that what happened in October 2008 was essentially the freezing of the entire financial system. So this was a very major event, possibly the worst financial crisis per se ever. Now, the interesting thing, in answer to your question, let's separate out the bankers, by which I mean broadly defined the players in the market, and the regulators on the other.
Okay.
I think, now I haven't been around for that long, so I'm just a reader of this stuff, but my impression is that, as it were, the technical training and competence of the people at the head of major financial institutions probably compares very well with that of the people in those jobs 30, 40, or 50 years ago. They've mostly taken finance courses at the best universities of the type you're familiar with. They are well trained and so forth. I think the problem is twofold. The institutions they are trying to manage are just, I think, probably an order of magnitude more complicated than financial institutions have been in the past. And this is true on many dimensions in terms of the range of activities they do, the scale, the number of countries they are operating in simultaneously, the number of markets they're dealing with. So this is an incredibly complex system. Remember, a really big bank nowadays has a balance sheet of about $2 trillion or so. This is an awful lot of stuff. And in addition to the complexity, they're trying to manage people, though they're trying to work on this, with some pretty lethal incentives. Namely, if they are successful in the short run, at least hitherto, they've been able to get immensely rich. And if they are unsuccessful, they lose their job. And the worst that happens is they can walk away probably with most of what they've accrued. These are pretty lethal incentives. And unfortunately, the management has the same incentive, perhaps a little less because it's so shameful. So I think the combination of the scale of what they're managing with the incentives of those they're managing really has made this job almost impossible to do well. And we saw that, I think, rather clearly. It's made worse also, I think, by the short-term nature of, if you like, the relationship with the shareholder. I mean, one way you could, in the past, think about the old partnership structures in investment banks or the stable shareholding of a big commercial bank. You've got owners who are sort of committed. But if your owners are essentially trading the stuff too, they're just interested in this year's profits. I mean, really they are. And it's pretty clear to me, I discussed this in a book that I'm just finishing, that quite a lot of the top bosses of the really biggest banks felt under overwhelming pressure from their shareholders to do things they actually knew were silly. I mean, think about it. I mean, I think the famous quote from Chuck Prince, then at head of Citi, about, as long as the music is playing, we must keep dancing. He knew that this was going to end badly, but he felt he couldn't stop. So I think the way the shareholder interacts with the financial firm is, to me, a very big worry in this system, because there are no long-term owners in the system. Capitalism without long-term owners is, I think, a very problematic structure, at least in the financial sector. Now let me turn to the regulatory authorities. Something quite interesting has been happening to the central banking and regulatory community, in my perception, over my lifetime, which is that they have moved increasingly from, as it were, practitioners, people who spend their life in that sort of business. There are exceptions, I'm just taking about tendencies, to academics. We now take it for granted that the heads of pretty well all our major central banks are essentially academics. A lot of the regulators, though not all, also have a similar background. um, the practice of running a central bank has become increasingly academic and dominated by discussions about how monetary policy should be conducted under various circumstances. In fact, financial stability more or less went out of the window, which I think is one of the reasons why we got into such a mess. Now, I'm a bit concerned about this. In fact, I'm more than a bit concerned about this. I actually think academics still have a place in central banks. It's better if they've also had some practical experience in markets, but I would think that it is really very, very important that the regulatory community in particular, this is more so than with monetary policies, though even there I think it's not unimportant, includes quite a number of highly experienced people who possibly even had a lifetime in banking and finance. There used to be people like that who would, think of Gerald Corrigan, for example, people who had a lifetime at the sort of the coalface, as it were. Don't know whether Americans use that expression, but anyway, at the coalface, who would be brought in perhaps in their 50s and 60s in senior positions. Perhaps they don't need the money anymore. And I'm concerned we don't really have that. So I think that one of the things that has happened, it's very clear in the UK, very striking, I don't know whether it's quite so clear in the US, is that the regulatory community doesn't have the hand-on experience of how the financial system is evolved and wasn't really very interested in that. I think that was one of the reasons we failed. Let me stress again, I think that I have nothing against the integrity of the people involved in regulation or even in the banking system. But I think the complexity of the system and the divergence in the experience of the people regulating and operating are both real reasons for concern. One of the reasons I want a simpler system.
So if we were to look ahead over the next decade, I know this is near impossible, could you just speculate on the 3 or 4 biggest challenges you think loom out there in terms of shaping what the global monetary and financial system is likely to evolve to? I realize nobody can predict this, but where do you see sort of the fundamental challenges, I'd say the biggest walls that are going to have to be climbed?
Okay, well, first of all, what I've said about technology and its impact is going to increase dramatically. Some people argue that the sort of, if you like, the Moore's law process, the process of increasing the complexity of our ability to process information is going to continue exponentially, and we've now got to the point that exponential growth really means something. So I suspect, I mean, this may be extreme, that basically almost all the trading in the world will be done by computers 10 years from now. A lot of them using very complicated algorithms against one another, which nobody will understand. So I don't know where that's going to end us up, but having seen 1 or 2 of the things that's happened already, this really worries me a great deal. It's not based on anything concrete. I can't say it will be, but it seems to me that's an ineluctable change. The second ineluctable change is that unless we have a break, well, I'll come to that in a moment. Assume no breakdown, that we manage where we are, that the global financial system will become more truly global. So 10 years from now, assuming no breakdown, certainly not much later than that, the biggest financial markets in the world will be in China. Or most people don't realize that already today, the flow of savings in China vastly exceeds the flow of savings in any other economy in the world, in dollar terms. So the additional savings being generated by Chinese people who are saving 50% of GDP and have an economy roughly a little more than half the size of America's. The Americans are only saving 20% of GDP. You can see that the Chinese are already saving much more. The moment that's all bottled up in China. But I think it's inevitable over 10 years, if you assume that nothing changes, that this will go worldwide. And we will have, along with that, new players. Every time a new set of players have emerged in the world economy, we've had a global crisis. That happened with America in the 20s, it happened with Japan in the 90s, 80s and 90s, because the financial system goes crazy. So the Chinese are going to become huge players, not only the Chinese, there will be others, but China will be the biggest. And finance, inevitably, an enormous part of the pool of savings, the wealth, the assets will be Asian. So it won't be, today we can say the global financial system is still essentially, if you like, Anglo-centric in the sense it's New York and London. I cannot believe that 10 years from now that will still be true. That will create extraordinary pressures on regulation, agreeing assumptions on how the financial system should work, and managing the interface between different regulatory regimes, at which we pretty comprehensively failed in the lead up to 2007, even though it was London and New York, which are the two closest cities you can imagine in terms of culture, language. We speak the same language, as it were, and yet the regulatory breakdowns, so many scandals in London. Why? Because the British were playing fast and loose, let's be clear. And I think that problem will get bigger. So that's the second gigantic problem. Third, I think the pressures, despite the concern we had for proceeding further with market-based finance, with securitized finance, with trading finance, will continue to grow. And therefore, the basic characteristics of a transactional financial system, I mean, it's a trend, but again, given what I've already said about the increased number of players, there will be much more of it. And we really don't know how to manage this sort of system in a stable way. We're trying very hard. We focus probably too much on banks. I've done that myself. Maybe we should be focusing more on what this is going to mean. And a lot of those markets where this trading is going to occur are going to be truly global markets. So I can well imagine a world in which, again, if we proceed on this current trend, where you take any sort of standard asset, corporate bonds, house mortgages and so forth, a vast proportion in every country, even in America, will be held by foreigners. It will be just normal, automatic. That will be, the shareholdings will be, we will no longer really to be able to think at all about national markets in any real sense. But we don't have global regulatory institutions. We find it very difficult to create this. And so this is I think my fourth thing, this tension between global markets and ultimately national regulatory systems, which are trying to coordinate through Basel and so forth. That tension is going to grow immensely. So that's my fourth really big thing. And that could lead, and that's the very last thing, I have this sort of back in my mind that at some point we might discover that we just cannot manage this. We cannot manage it. Probably it will be another crisis, and we reverse it all, as we did in the 30s and 40s. We basically put down, that would be immensely difficult, but it would not be impossible. But the trends I see, leaving aside that last sort of nightmare possibility of a breakdown, are all in the directions, like I said, more technology, more trading and securitization, more Asia, and more conflicts between global markets and national regulators. And I could talk about institutional changes. Will the universal bank continue? Oh, that seems to me actually secondary to the changes, the big four changes I've mentioned.
So where does this leave us with regard to the need for long-term financing in big infrastructure? Let's say the retrofitting of the world for environmental purposes, or all of the building of cities and all of that. You're describing a world of very short-term transactional finance, writ very, very large. Does this have any implications in terms of the more traditional use of finance to build things?
I think that's a fantastically good question. And it's something that has worried me increasingly. Now, in theory, the combination of equity markets with long-term bond markets ought to be able to do this sort of thing. That's what they're for. And we can see that there are companies that have been successful companies that have been able to fund long-term investment through equities. But of course, on the whole, these are companies which have staggeringly fast-growing markets, such as the Apples and Googles of this world, or have a track record like GE. There aren't that many of them. It is frightening how few AAA rated companies are left in the world. When I last looked, they were down about 12. I don't know how many it is today. If you set up a new company designed to make enormous investments in infrastructure using bond and equity markets, with the sort of standard returns you would expect in such markets, I think it would be outside the heavily regulated sector almost impossible. So I have increasingly come to the view that, and this is what I've been arguing in the UK with absolutely no success whatsoever, and I believe people have made similar arguments in the US with equally little success, is that we must see this as a public-private partnership. That we must develop these as part. One of the lessons of the crisis to me, something that I hadn't seen so clearly, I hadn't expected, is that when push comes to shove, the only really sound long-term borrower on a large scale is the most permanent and stable player in our system, the government. What else? It's true for you, it's true for us, it's true for everybody, all the well-run states of the world. Now, I'm not talking about Greece, but the others. On the other hand, I don't believe the government is the best manager of these things. I don't believe the evidence is pretty clear that the private sector's role in innovation and in managing and delivering projects of this scale is essential. So I believe that the imaginative way to go will be and I believe it's possible, I've thought a bit about it, I haven't written much about it, is to combine the government's capacity to fund long-term projects with the private sector's capacity to manage, implement, and innovate. And that can be done by creating structures, they must be much better than the past, which deal with risk management. It's a contractual problem, but one of the advantages of the new information technologies, I think, and also the new theories in this area, is that we understand better how to manage contracts of this kind, using auctions, auctioning is a very good way of doing this. We do this with offshore oil exploration, for example. It's the provision of essentially a government permit to extract the resources. So I believe the future in this absolutely indispensable area is imaginative public-private partnerships. Unfortunately, I can't see any countries in the world that are doing this really well at the moment. We can go into the details. The Chinese are doing the borrowing, but they're not managing the infrastructure very well. And in the US and UK and other developed countries, they've got a hysteria about debt levels, which don't allow them to look at the question, yeah, but what about the assets you're creating? So to just look at one side of the balance sheet, as I've said many, many times, is ridiculous. It's bad economics, obviously bad economics. Anyway, that's the way I would go, because I don't believe in most areas, there are some areas where you can create incentive structures where the private sector will just get on with it. I think it is possible, at least in the shorter term things. But for really long-term infrastructure and innovation, science, all the rest, it's got to be a public-private partnership. The West has done this very successfully in the past, and I think we could do it again if we got away from this prevailing sort of view that the government is completely useless at everything, which is actually inconsistent with our own historical experience. And I felt in 2007-8 we got an experience then, well, the private sector can also make mistakes. Everybody can make mistakes, but let's build on what we have. So that will be my answer to you.
So here's a final question, and it's a slightly different tangent. It has to do with journalism.
Oh my God, yes.
This world that you are describing is a world that is filled with much more technology, much more decentralization, massive amounts of information, a lot of it imperfect. Speed. How has the craft of financial journalism changed in the last couple of decades, and where do you see it going? How are we going to get, what are the future Martin Wolfs going to have to be able to do that is different than perhaps what you were doing, let's say, in the 80s or the 70s or the 80s?
Well, I only started this in '87. Before that, I was an economist, and then I got brought in this. My background and what I do is very different from what most journalists do. Let me separate out two aspects of journalism and then consider this. The first is the journalist as reporter,
Okay.
which is the core of it, and then there's the journalist as commentator, which is my particular role. Now, the journalist as reporter has a big advantage over 20, 30 years ago and a big disadvantage. The big advantage you've already mentioned, and in a way they're the two sides of the same coin. The big advantage is there's much more information. So I remember when I started, even quite simple things, getting government reports. So I started in '87. So getting hold of a government report on anything, getting hold of government statistics on anything, particularly anything that was outside the UK, could take days. It had to be faxed. I used to call up my colleagues, it seems ridiculous now, in the Washington office when the US trade figures came out and asked them to fax them to me. And that was quite a business. So obtaining information on anything was really hard. The reports on corporate reports would be faxed. I mean, and that was slow. So we are drowning in information. That's an incredible improvement, and it's wonderful, actually. But of course, the other side of the same coin is it's much more complex. So you've got stuff, but you don't quite know how to interpret it. So let us consider the problem of reporters, of whom there are always far fewer than participants in the major news organizations than participants in the market. Look at their problem before the 2007-8 crisis. This was a global market. The products were globalized. The players were operating globally. The regulators didn't understand how they all fitted together. And the reporters just saw little bits, tiny little bits of this. They had no way that they could put this all together. Unless you can put it all together, you don't really know how worrying it is. I have one or two people, my colleague Gillian Tett, I think, was a remarkable example of this. There are a few Americans who picked up some of this in a big enough way to realize there was a problem, though even they didn't realize the scale of it. So what tends to happen, I think, inevitably, and I don't blame anyone for this, I think the same is happening even for the participants, let alone the reporters, is you do get a pretty good idea, if you work very hard and you use the available resources, of what's going on in a small area of the system, but putting together an idea of how that will interact and possibly blow up. Because this is crucial in understanding the financial crisis, I think. It wasn't because one little bit blew up. It was because of a lot of bits blew up together. And their linkages, and I could describe this at great length, because I think we now have a better idea of this, were just, nobody understood these linkages and next time it will be different. Now, in the old financial system, which was essentially national or even in America state level, where you have assets, roughly what there are. A bank would have agricultural loans. Its liabilities would be to its depositors. It would have very little trade with other banks. Very little. We tend to forget. A historical bank was a silo. So there were always some connections, but only in the major markets and for a limited range of assets. Say, historically in the UK, for example, it was short-term bills of exchange, but that was the only thing that was widely traded in the private sector. So the banking structure was really simple. The S&L crisis was essentially a very simple crisis. You could see how it worked. I think that's become almost impossible to do now. So, and then finally, the journalists have the problem that our businesses are all under pressure, so we're shrinking. Their resources are shrinking. So I think we know more, but it's very difficult to know what it means. And that's also, to some degree, true of the commentators. Now, the commentators are entitled to take, big gambles, to make guesses. But if you want to be anchored in everything that's going on, it's impossible. You always have to go for some angle of it. And I look back on what I myself realized and what I didn't. There was some things, the macroeconomic side, I think I understood reasonably well. The pressures driving the US and the world economy, I think even now I'm happy with that. But the way it would break and bend the financial system, I didn't understand, because I didn't understand how the money was flowing through the system. And the reason I didn't understand how the money was flowing through the system, it was just too complicated. There were too many bits I didn't know anything about. I didn't know what was happening to housing finance in California, and how that then got to these securitized assets and what the rating agencies were doing, and then how AIG was evolved. These were just things you didn't understand. So I think that we are very dependent as commentators beyond the macroeconomics, which is a consistent, coherent and field of analysis with good data. Once we get beyond that into the financial structure, we're in the same position as everybody else. We don't see how the pieces fit together. So we are drowning in information. In some ways, that's much better than ever before. But I think the difficulty of actually getting a sense of what it means has grown for us, as it has for everybody else, the regulators, supervisors, and the practitioners. I think that's just inherent in what we have created, which I think of as a very remarkable thing. But it's also, let's be honest, something of a Frankenstein's monster. It's not something today, partly because at this point I've emphasized again and again the depth of the interaction in the system across the world, which is completely new in its intensity, though it's existed before. That's just something none of us is really equipped to get a handle on. And we fall, both reporters and commentators fall into the same thing. Now, as far as, if I were a new me, as it were, I would advise myself to do what I didn't do, which is to spend 5 or 6 years working in a financial institution just to work out how they worked. And I tend to think that just as regulators and indeed academics doing finance should do that to understand how this looks, I think reporters and commentators should be doing the same thing. Most of us are too specialized, and I think that's true of us all. And a certain degree of breadth of experience, though that's not going to be the answer to everything, and things change, so you will become out of date. But I think particularly in finance, the economics isn't too bad, but the financial sector's operations are really difficult to understand if you're not part of it. It's only a small improvement, but I think it's part of the broader problem we've defined, which is that we've created something which, in all truth, whose operation we don't fully understand and whose management we can't be really confident of.
Martin, that's a great place to stop. I can't thank you enough. It was a really, really interesting tour d'horizon of a lot of issues, and I thank you very much for that.
It was a great pleasure. I enjoyed it.
Thank you.
Thank you.